Tariffs, tariffs, tariffs. If you're like me, that is all you have been hearing the last couple weeks. So today we are going to tell you what tariffs are, a little bit of history on them, how they're being used today, and most importantly, what they mean for your investments. Let's dive into it. Okay, so to start off, tariffs are a tax, and in just a minute we're going to talk about how they are being used today, but we need to first go back to George Washington's time because he was the first president, obviously, and he signed a major piece of legislation called the Tariff Act of 1789. It placed a 5 to 15% tax on imported goods, and the reason was twofold. Number one, it was to raise revenue for the brand new federal government at the time. And number two was to protect brand new American companies that were starting to get their footings. Now, here's the way they worked. Let's say there was a U.S. company that was importing from the UK cotton, and this would place a 15% tax on that product. So if the cost was $100, this would go to $115 would be the cost that they would pay, and the company would give $15 to the U.S. government for their revenue. They would then have to decide what they were going to do, whether they were going to raise prices for their customers, whether they were going to go try to squeeze their suppliers and make them pay for some of it, or whether they were going to eat it themselves. But the bottom line was that's how it began. Now, we have seen in recent years, during the 2018-19 time period, we saw Trump using tariffs mainly to hit on China. He put a lot of tariffs in place on them at the time. It wasn't widely praised from folks in, economic analysts. But actually, when Biden took office, he left those tariffs in place and, in fact, raised some against China. Now, today, he's primarily been using it as a negotiating tool. If you think back to the last weekend, and we're filming this in early February 2025, there was the threat of putting a 25% tariff on Mexico and on Canada. And at the very last minute, there was an agreement with the Mexican government and the Canadian government that they would send 15,000 troops each to their borders to try to stop the flow of fentanyl across the border. And that was viewed as a win by the Trump administration. He then said, hey, we're putting a 30-day hold on these to just make sure that you follow through and do what you say. And if so, these tariffs will not go into effect. So this past weekend, all you heard about was fear-mongering really around these tariffs. They're going to cause a lot of inflation. They're going to cause the economy to struggle. They're going to hurt corporate profits, all of these kind of things. Well, fortunately, we have a recent time period we can go back and look at to see if those kind of things actually took place. And that is the example of 2018 and 2019. So first, we're going to say what happened to GDP growth, the economy during that period. And if we look at 2018 through January of 2020, the pre-COVID period, GDP growth during that time averaged 2.8%. Now, again, anything above 2% is very, very good. So 2.8% growth, very, very strong. That's what we saw there. Next, on inflation, the CPI, the inflation rate during that period averaged 2.1%. The Fed's target is 2% goal, so it was slightly above that, but very, very close. And if you look at a comparison, these last few years, inflation has been much, much higher. So during that period, the fears that inflation would run rampant, it just did not happen. Now, in addition to that, unemployment in 2019, late 2019, so through the period where tariffs had been implemented against China and a few other countries, unemployment hit a 50-year low at the time of 3.5%. So the jobs market was in a very good place there. There had not been mass firings like a lot of people thought it would be. The other 2 points I want to make, number one, manufacturing activity remained in expansion period during that time. And that's important because the fact is the United States is a service services economy. Back 100, 200 years ago, we used to make a lot of products here. That's not the case today. We're mainly a services economy. So services still could handle that time with more tariffs without too much trouble. Manufacturing, they had higher prices, but yet it was in expansion territory. That was good news. Lastly, consumer spending was very robust, despite the fact that some products went up in price at that time. So that was all good news. So those were the economic implications. Now let's talk about the most important thing in our world, the stock market, how it did in 2018, 2019. And the first thing I want to say is on days that there were announcement of new tariffs, oftentimes the stock market didn't take those well, with declines of 3, 4, 5% in short order. But those were very short lasting. The markets quickly bounced back. Now, as a side note, we saw that here in early February last weekend when you had all the concerns about the potential tariffs on China, Mexico, and Canada. On Monday morning, the stock market was down over 1,000 points, over 2.5% pre-market on fear of those concerns. Well, by 3 o'clock in the afternoon, those declines had evaporated and the markets had recovered fully as they realized, hey, those tariffs were likely not going into effect in the short order. And investors realized, hey, these were really negotiation tactics. Now, let's go back, though, and look at 2018-19 when some tariffs did stay into effect for a longer time period. Over that 2-year period and up through January 31 of 2023, we have a chart of the stock market, and you will see the S&P 500 here was up 25% in that time. That is in purple right there. Guess what? The tech part of the market, which we have been overweight tech for many years here, was up 43%. And that's because the makeup of a lot of companies that aren't impacted by the tariffs, a lot of tech companies are in that department. So they were up 43%. If you look further, the Dow Jones Industrial Average up 19. Now let's get to some of the losers during that time. Industrial stocks up 11%. So it's not too bad, but it's not 25 and it's not 43. And this was because a lot of industrials are importing and buying products like steel and lumber, and they were paying higher cost on those. That hit their profits a little bit. They didn't make as much money. The Russell 2000 small caps up 8%. Listen, this is important. If you listen to stock analysts, they told you during that time, hey, small cap companies should do well during this period because these are domestic companies. They're selling to U.S. customers. Many of them are not buying products from overseas. They should do well. But actually, they did not fare nearly as well as the markets, only up 8%. Lastly, the biggest laggard, retail stocks, down 2%. Listen, a lot of companies that sell retail products are buying shirts from China, phones from China, and you go down the line, different products, washing machines, they had higher prices, and so those companies didn't fare well in the markets. So like we said, during the 2018-19 time period, there was major fear around how companies here in the US would handle tariffs, how their stocks would do. Let's look at a couple names that everyone knows, and I'll start with Nike, who had a lot of tariff exposure due to Chinese manufacturing. They successfully shifted production to Vietnam, Southeast Asian countries. Their stock went up 57% during that time period. Walmart initially warned about price increases due to tariffs. However, they negotiated with suppliers to share costs. Their stock was up 21%. Home Depot, they also worked with their suppliers to shift production to other countries and move some production here in the United States, and they managed to maintain margins despite concerns about the tariff impacts. That stock went up 26%. Last, the company everyone knows, Apple. And they have a heavy reliance on Chinese manufacturing back in 2018, which was going to cause increasing iPhone production costs. There were fears that Chinese consumers might boycott Apple products. That did not happen. Apple focused on services revenue growth, supply chain management, working with suppliers. They did have slight price increases on their phones, But they also did stock buybacks, and guess what? Their stock went up 88%. Here's the most important point that covers all of these companies. Tariffs are only one issue, and it is important even today to not get bogged down and focus just on one issue. Far more important are what is the strength of the U.S. economy? How are companies in the United States doing with regards to their outlook for revenue growth and profits? What's tax policy going to be? And what's happening with regulations? And if you take all those into account, 2018 and 19, it was a good time for the stock market. We believe the same will be true in 2025. So my last point, I'm going to take things and look at February 2025. We have had many companies in the S&P 500 report earnings for the fourth quarter. We have a chart here going back to the fourth quarter 2017 that looks at how many companies out of the 500 in the S&P 500 mention tariffs on their earnings calls. And what you will notice on the far right here for the fourth quarter 2024, so in the last few weeks have been the calls, you can see that we have had over 200 companies have mentioned tariffs. That's more than at any quarter in the last few years, going back to 2017. So listen, companies do have to try to plan for these, and that's hard to do when there's a lot of movement from one day to the other, and that can cause a little bit of uncertainty. But here's my point about this. The stock market is just 1% off its all-time high at this time. These companies on their earnings calls are mentioning that tariffs are creating a little uncertainty or what they are doing to try to prepare if they go into effect. But far more important, these CEOs and CFOs have business confidence. They are excited about the year, and that's all throughout industries. Tech, consumer-facing companies, industrials, financials, doesn't matter. All of them are saying very similar things. We like to see that. Now, if you are new to Centera Capital, this is the first video you have watched, and you're not getting updates from your advisor, we give market updates every other week. You can subscribe on our YouTube channel. You can also go to centeracapital.com and reach out to us if you'd like to talk to us. We have a 3-meeting process to see if we are a good fit. So the main takeaway is that tariffs have been around in the United States since the days of George Washington, and they've been used in different ways by presidents over time. Right now, they are being used primarily as a negotiating tool, but we will closely watch that. And listen, tariffs do create some market uncertainty, but we believe it's just one factor, and you don't want to overreact to that. When you take a look at tax cuts, reduced regulations, and increased business confidence, we believe those will have a far greater positive impact than the negative impact tariffs may have on the markets. See you in the next video.